Good morning everyone. We are tasked to report about financial and fiscal administration here in the Philippines. With my partner, Mr. Alan J. Acanto, here is our discussion.
In this particular topic, we are going to look at the Philippine financial system.
Resources continue to increase. In the last 10 years, the financial sector has benefited from a number of liberations and deregulations initiatives as globalization has taken root more strongly in the Philippines. The financial sector is a section of economy made up of firms and institutions that provide financial services to commercial and retail customers. This sector comprises a broad range of industries including banks, investments companies, insurance companies, and real estate firms. In the last 10 years, while globalization had caused more in the Philippines, this financial sector benefited from more initiatives which results to the steady state of the Philippine financial system in year 2000. In November 2005, the total assets of the Philippine banking system amounted to 4.4 trillion, more than double the amount recorded in 1996, which continued to be the dominant players in the industry, accounting for more than 90% of total assets.
In this table, in the first table, it represents the total assets of the banking system all throughout the years from 1996 to November 2005. The banks here are identified as commercial banks for KB, trust banks for TB, rural banks for RP, and the specialist government banks. In 1996, all these banks' total assets amounted to 2.1 trillion pesos. But in November 2005, the amount doubled to 4.4 trillion pesos. And in both cases, more than 90% of the total assets came from the commercial banks. And the table below shows the growth in percentage. In 1996, the total growth in percentage of all banks in the Philippines amounted to 32.49% compared to the previous year. But in November 2005, the total growth amounted to 4.73%. Why is that? It's simply because expansion. Governments will expand assets to expand their influence and capabilities to serve their customers.
Banking system attempts consolidation. The ongoing restructuring of the banking system, which involves the consolidation and closure of weak banks, resulted in a reduction in number of banking institutions from a peak of 1,003 in 1997 to 881 as of end of September 2005, which could be shown in Table 2 in the next slide. The total number of banks comprises 42 KBS, 84 thrift banks, and 755 rural banks. In banking system, it is a group of or network of institutions that provide financial services for us. These institutions are responsible for operating a payment system, providing loans, taking deposits, and etc. In financial accounting, consolidation is defined as a set of statements that present a parent and subsidiary company as one company. While the restructuring or reorganizing is ongoing in the banking system, it's resulted to a reduction in a number of banking institutions of 122 from 1997 to 2005 end of September.
In table number 2, we can see a graph or table representing the process of consolidation. In 1996, there are a total of 6,332 financial institutions, which includes 961 head offices and 5,371 branches or agencies. This grand total increased by September 2005 in 7,653, 800, of which 881 are head offices and 6,770 are branches or agencies. And as you can see, the branches and agencies increased, but the head offices decreased. Why is that? That's simply because of consolidation. Consolidation is the process of focusing your assets and acquiring more through the purchase of competition. Mergers are also part of the consolidation process. And in this case, it just meant that larger financial institutions, the ones with more assets, have bought off their competition and established new branches. So, for example, Bank A is a well-off banking institution, and Bank B is a rural bank. Of course, Bank a commercial bank, would definitely have more assets than Bank B, which is the rural bank. So once the rural bank or Bank B goes in the red and is unable to maintain service, Bank A will buy them off. Or if rural bank or Bank B is growing in size and becomes a threat to Bank A, Bank A would either buy Bank B or propose a merger in which two banks became one.
So next is deposits and loans continue to grow. So the banking system's deposit liabilities expanded by 124.2% as of end July 2005 to 2.849 trillion compared to the 1996 level of only 1.271 trillion. So saving deposits still comprise more than half of bank stable funding base. So deposit mobilization activities of bank include relocation of new branches and installation of automated teller machines in new sites. So when bank customers deposit money into a checking account, savings account, or certificate of deposits, the bank views these as deposits as liabilities. So after all, the bank owes this deposit to its customers and are obliged to return the funds when the customer wish to withdraw their money.
In this graph, as we can see, from 1996, there's a steady increase in the deposit liabilities of the banks in the Philippines. In 1996, it was around 1.3 trillion. And if you look at it in July 2005, the amount has more than doubled. And most of the deposit liabilities of banks comes from the deposits of their customers.
So here is the graph of loan outstanding of commercial banks. So as you see, the changes of billions in year 1996 to 2000 and 2000 to 2000 to the end of September 2005.
Asset quality continues to improve. So non-performing loan ratio of the commercial banks rose from 4.7% in 1997 before the Asian financial crisis to a peak of 17.3% in 2005. The NPL ratio was brought back to a single digit by 2005. The decline and steady progress in banks' deposition of their assets is reflected through the implementation of the Special Purpose Vehicle Act in 2002 and through the modest rise in total loans of banks. The disposal of idle assets in the Philippines was private sector led, of course, since most of our banks are commercial banks. While in other Asian economies, it was the public sector, as their government has a better hold on the banking and financial institution or financial system. The special purpose vehicle offered incentives such as exemption from documentary stamp tax and capital gains tax. And around 17.8% of banks' non-performing assets were disposed of under the Special Purpose Vehicles Act of 2002. So, the Special Purpose Vehicles Act was a great way to dispose of non-performing assets because an economy cannot perform if the flow of money is stagnated. The money just needs to keep flowing from the banks to the consumer, then to the producer, back to the banks for savings or deposits. That's the basic money flow in an economy. Because, of course, producers would charge money for the products and services they produce, and they would need to profit. So if they cost them, for example, X to produce this product, they will increase it. They would put a profit margin there. So instead of listing product as priced X, it's gonna be priced Y, which means from price X, it increased in value. And that value serves as the profit margin for the producers, which they then save and deposit through banks.
NPL or total loans in percent. So NPL refers to non-performing loans. When a borrower has not made regular payments for at least 90 days, the loan is considered a non-performing loan or NPL. So as you see, the NPL ratio of the commercial banking system rose from 4.7% in 1997. In year 1997, so before the crisis, and it reached out the peak of 17.3% in 2001. And however, the NPL ratio was back to a single digit level in June 2005, and in November 2005 it is in 8.79%.
Okay, capital position remains above prescribed norms. Of course, you need capital to start projects or businesses. Capital refers to the funds you need when you undergo a project. And the banking industry in the Philippines continues to be well capitalized due to the fact that commercial banks, together with trust banks or rural banks, have at the very least 4.4 trillion in assets as of November 2005. And the capital adequacy ratio of banks on a consolidated basis was recorded at 18.1% in March 2005, and this ratio exceeds the 8% Basel I standard and the 10% set by the BSP. Tier 1 capital comprised 99.4% of the qualifying capital. Compared with those of its counterparts, our countries' capital adequacy ratio are above those of Malaysia, Thailand, and Korea, which are also above the BC1 standard. But just imagine, the standard was set at 8%, and we have a capital adequacy ratio more than twice of that, which means that a financial crisis wouldn't hit hard as much as it would hit other countries because we have enough capital to keep the economy working. Private partnerships are part of the government's way to involve the private sector in the flow of money in an economy, because a money just deposited in a bank, as what I have already discussed, is not performing. It will stagnate the economy. So the government, with a partnership, would be able to involve the private sector in the stimulus of the economy, at the same time reduce the burden of costs that it should shoulder, because the private sector that's involved in a cooperative project with the government would also use their own assets in order to proceed with the project.
So, capital adequacy ratio and financial system. So, capital adequacy ratio or CAR is a measurement of a bank's available capital expressed as a percent of a bank's weighted credit exposures. So, as you can see, countries' CAR and CAR remains above those of Malaysia, Thailand, and Korea, which shown CARs above the Basel I standard.
Loan provisioning affects profitability ratio. What are loans? Loans are money that were lent by a financial institution to a private individual, corporation, or entity with an interest rate. The longer the money is not paid, the higher it goes. So, for example, I took out a loan of 10,000 pesos from Bank B, and Bank B has stated in a document which I signed prior to be to being granted a loan that I must pay the 10,000 pesos by this time. So, also in that contract, there's a percentage of interest for every month, year, or any specific time stated in the document. So, for example, the interest rate for my loan is 3%. Let's say it's 3%. So, what's the 3% of 10,000? That's 300. So my monthly interest rate of 3% would make the loan that I should pay into 10,300 by the first month, 10,600 by the second month, and 10,900 by the third month. Because as far as interest rates are concerned, interests are mostly applied to the capital loan, not to the interest total amount to be paid of the loanee. And with loan provisions like that, it's even harder to get loans. So the bankings have seen a decline in the profitability of loans to private individuals and entities. This decline happens mostly on a short term, but with a good economy, it would easily recover in long term. And the bank earnings recovered in 2001 and through 2003 after a steady decline back then, but resumed their downward trend in 2004.
Banking system profitability in percent. So banks profit by earning more money than what they pay in expenses. So the major portion of a bank's profit comes from the fees that it charges for its services and the interest that it earns on its assets. So its major expense is the interest paid on its liabilities. So as you see, bank earnings recovered in 2001 through 2003, but resumed their downtrend in 2004. So the spike in profitability in 2003 resulted from a significant reduction in below the lines item.
Here, we will discuss the financial stabilities, issues, and challenges that our banking and financial institutions face.
Domestic financial system has demonstrated resilience to external and domestic shocks since the 1997 financial crisis. So, financial system is a set of institutions such as banks, insurance companies, and stock exchange that permits the exchange of funds. So, in year 1997, the domestic financial system recovered from external and domestic shocks, which are sourced from the return volatility from 24 developed, emerging, and frontier stock markets. But, however, there are some remaining issues need to address and cater.
Here we have the improving asset quality. Of course, money is a great commodity. It is a great asset in the economy. However, due to inflation, the value of money drops. And when the value of money drops, do you consider it to be a quality asset? Of course not. So, the first step is to ensure that your asset is of the highest quality, something that no other person can stipulate of to be lower than that of their real value. And here, a non-performing asset is of lower value. So banks need to clear up their balance sheets to determine the overhang. And the overhang has declined in recent years, but it remains relatively high prior to pre-crisis levels. With weak balance sheets, banks have been risk averse, which means that they don't risk loans and grants that much. And but that also means that They have reduced credit for investments. Most of their money have become stagnated, and this will render the system vulnerable. And in case of big bank failures, it would cause a domino effect.
So one of financial policy response is that managing risk exposure. So the regulation, technologies progress, financial innovations, changing taste, and demographics are increased market competitions have all combined to dramatically transform financial service industry. This is a continuing and dynamic process. So in financial system, risk could not be avoided since it is a part of progressing. So managing risk include regulation, technological progress, financial innovations, changing taste and demographics, and increasing market competition, which transforms the financial system industry.
What would help our financial system? Of course, it needs a well developed and strong domestic capital market. And I think that our capital market, domestic capital market, is steadily developing, but it's not up there to be the backbone of the financial system. One of the goals of the Bangko Sentral of the Philippines and is to deepen and develop the domestic capital market. It's one of the most integral part of the financial system, and a robust, in this case, a competent and strong domestic capital market will complement the banking system in financial intermediation, which means they would be able to share the burden of a collapsing financial system, and would be able to recover faster than that of a financial system that only leans towards the banking system. And also, a strong and well-developed domestic capital market ensures sustainable and sufficient funding of large-scale or long-term government projects. For example, the expressways were a partnership of private institutions and the government. And the private institutions have invested a lot of their money towards the development of the expressway. Why is that? Because they would be able to gain much more with a well-developed road or the expressway in compare as to when they did not invest. Because if they invested, they would be able to ensure the quality of the project in comparison to just letting the government solicit funds and go off on their own.
Financial policy response. So in financial policy response, there includes the policy response to intensify financial sector's problem. Fed officials created new lending procedures in the form of Team Auctions Facility or TAF and the Primary Dealer Credit Facility or PDCF and changed their securities lending program, creating the term Securities Lending Facility TSLF.
Of course, the financial policy is to respond quickly to any and all sorts of danger that the financial system may be subjected to. And here, particularly in the aftermath of the 1997 Asian financial crisis, The BSP has strengthened the banking system's ability to respond to challenges brought about by globalization and shocks posed by global economic crisis. Of course, once a country has decided on participating in globalization, its economy becomes dependent also in the global economy, and in that case it also faces the risk of collapsing once a global economy crisis occurs. For example, during the 1930s, there was the so-called Great Depression, and most countries that are economically linked suffered devastating recessions and inflations. Of course, a strong banking system will allow the country to alleviate some of the negative impacts of a global economic crisis to countries that have started to participate in globalization. For example, the United States of America during the 1930s have a strong banking institution, not to mention a powerful domestic capital market due to the fact that the United States of America is one of the most industrialized country back in the 1930s era. So we in this case, the BSP aims to strengthen the banking system further so that it could cushion any negative effects of a possible global economic crisis. And the focus of the BSP's prudential strengthening is the prudential regulatory standards and aligning them with international norms. International norms tend to be the benchmark of what the regulatory standards of a banking system should be. And of course, there would be better risk management, greater transparency, and promotion of good corporate governance and the reduction of moral hazard as proven already by international bank standards, more particularly the Swiss banks, because not only are they very strict in terms of regulating bank accounts, they are also the model of a very reliable banking institution, as no country in particular has control over the Swiss banking system. That furthers the trust of its customers to the safety and security of their assets deposited within Swiss banks.
So the first financial policy response is improving assets quality, which its strategy is to mobilize private investments in order to rehabilitate the banking system.
Here we can see that the classifications of loans. So first would be the unclassified, which accounts for 0% allowance. Loans specially mentioned at 5% allowance. Substandard as none. Secured is equivalent to 6 to 25% allowance. Unsecured has 25% allowance. Doubtful has 50% allowance. And loss has 100% allowance. If you can notice, these allowances allow the banks to be able to recover their losses. Just look at their allowance in the lost loans. It amounts to 100%. Why is that? Because it's a loss. You can no longer retrieve the money you have loaned out. But because of the allowance, it allows you to actually break even your losses, which means that you only maintain a net gain or loss of zero.
So the SPV Act of 2002 sets out the legal, regulatory, and taxation framework for banks and other financial institutions to sell non-performing and acquired assets. The law aims to help institutions securitize their assets by granting tax incentives to assets management companies or special purpose vehicles. So the SPV So the Republic Act 9182, also known as the SPV or Special Purpose Vehicle Act of 2002, was signed into law to help Philippine banks get rid of their non-performing assets or NPAs. So by helping banks clean up their balance sheets, in RA 9182, which is also often referred to as the SPAV law, aims to help stimulate the economy by helping banks to be more liquid and be able to lend more money to business.
I'll discuss the SPV. Under the Act, an SPV is required to be a stock corporation with a minimum paid-up capital of 31,250,000. The selling bank is permitted to own up to 5% of the outstanding capital stock of the SPV. And an SPV is allowed to issue investment instruments to finance its acquisition of non-performing loans and foreclosed assets. Foreclosed assets are those assets that were taken in by the government, by the bank as collateral for loans. And these IOIs are to be registered with the SEC or Securities and Exchange Commission prior to being sold or distributed to permitted investors within the Philippines. The SEC is the regulatory commission when it comes to the exchange of assets aside from that of money. The SEC is especially involved in real estate, and on the other hand, the Securitization Act of 2004, the companion bill of the SPV Act, it aims to improve the legal standing of securitized issues, promote securitization for the development of 304 BIS papers number 28, the market, or known as the capital market, and pursue the development of the secondary market for asset-backed securities and other related financial instruments. The secondary market here refers to a market financial institution can use as a caution just in case that the national or the no local domestic capital market or the domestic capital market is unable to cushion the blow.
So, under this securitization law, assets may be sold with recourse to a special purpose entity or SPE, which then issues securities backed up by a pool of similar assets. Several taxes will be granted to encourage financial institutions to transfer housing mortgage to SPES, while SPS will still have to pay income taxes like any other corporation. Transfers of assets will be exempt from value added and documentary stamp tax. So, the Special Purpose Entity or SPE is a fenced organization having a limited predefined purposes in the legal personality. So, normally, a company will transfer assets to the SPE for management or use the SPE to finance a large project, thereby achieving a narrow set of goals without putting the entire firm at risk.
So other provisions include prohibiting the national and local governments from securitizing receivables arising from future expectations of revenues such as royalties, fees, internal revenue allotments, etc., at the expense of their successors, which means that a government, that both the national and local government cannot securitize any expectations of revenues because it will harm their successor, and each securitization plan should be prior registered with the Securities and Exchange Commission.
So the second financial policy response is enhancing risk management. In the past 10 years, the BSP has implemented several major improvements in Philippine banks' risk management practices. So the BSP efforts to focus on risk management is ultimately intended to give banks greater flexibility to respond to changing opportunities under a more deregulated environment and at a time of rapid technological advances. So, risk enhancement is a risk response strategy aimed at increasing the probability of a positive risk occurrence. So, this is usually achieved by creating conditions whereby an opportunity is more likely to materialize.
In developing the capital market, the BSP implemented or supported the following reform initiatives. First is the establishment of a private sector-led fixed income exchange. Second would be the institutionalization of a third-party custodianship for securities. Third is the creation of investment trust funds to replace common trust funds. Fourth is the upgrading of the payment and settlement system into a real-time gross settlement system or RTGS. The development, and last but not least, is the development of domestic rating capacity to meet the growing need for credit rating services of both financial industry and regulator. Do you think these steps of the BSP or reforms of the BSP will lead to the development that they wanted?
The Public Fiscal Administration and Local Government Unit. So, Local Government Unit or LGU focuses in a program of good governance, economic development, and public fiscal administration that is valuable and beneficial to the community, businesses, and welfare to the people. So, public fiscal administration or fiscal administration generally refers to the processes involved in the revenue generations, allocations, and expenditures of the government. So, the public finance belong to the branch of economics, but that was during the earlier times. So, LGUs are the arms of national government, which it is a way of making to reach out of rural communities.
Okay, so we'll go to the local income and revenue collected by local government units or LGUs. Internal revenue tax is the primary source of revenue or income for LGUs that the national government gives proportional shares to be used as public funds. These are the taxes. Taxes defined as obligatory shares or contributions coming from a person or property imposed by law to support the local national government for the public needs. Of course, a government would not be able to provide services unless it has the funds, and those funds come from the revenues or taxes that are imposed upon the citizens. Business taxes are enforced by LGUs. That's why businesses needs to be registered with their local government units so that they can be issued a business permit. And because businesses are a privilege and not a right, the local government is allowed to impose taxes on any business within its jurisdiction. Of course, a local government cannot impose taxes on a business that is not within its jurisdiction. For example, a business that is solely found in Laguna cannot be taxed by the local government of Cavite because it is not in the jurisdiction unless that company would build a satellite office or a site in Cavite in which the local government of Cavite would be able to tax their local business or the branch that the business has established in Cavite. And however, the proceeds of these taxes accrue exclusively to the LGU then possess them or when time given by law is be able to be shared with other LGUs. However, the imposition always remain with the ones who have jurisdiction.
So the province, municipality, and city may impose a tax on the business of persons engaged in the printing and publication of books, cards, posters, leaflets, handbills, certificates, receipts, pamphlets, and other of similar nature at a rate not exceeding 50% of 1% of the gross annual receipts for the preceding calendar year. So, in the case of a newly started business, the tax should not exceed 1/20th of 1% of the capital investments. So, in the succeeding calendar years, regardless of when the business started to operate, the tax shall be based on the gross receipts for the preceding calendar years or any fraction thereof as provided herein. So the receipts from the printing and or publishing of books or other reading materials prescribed by the Department of Education, Cultures and Sports as school texts or references shall be exempt from the tax herein imposed in Section 136 in Local Government Code.
Fund management practices, of course, pursuant to good governance of local funds, it is mandatory upon the local fiscal managers or other fiscal officers to embrace and apply effective fund management practices benchmarked from private sectors or industries in the daily operations of LGUs. Of course, a good government would always be transparent and they would be able to utilize the fund to its fullest. Oh, and managing funds should not be an issue. Of course, mismanagement of funds would be seen as grounds for corruption. And good governance is the exercise of economic, political, and administrative authority to manage the country's local government affairs at all levels that are serving the interest of the citizens meet their obligations, exercise their rights, and intervene their differences. Of course, a good government would always use their funds for the betterment of their people, although not every one of their citizens would be able to benefit from their governance. Just like the saying goes, you can't please everyone. And while ideally a government should pursue to serve all the interests of all, it's virtually and realistically impossible because, as I said, not everyone can benefit from the project of the government, especially the private sector cannot benefit from, for example, a program of cash grants towards those who do not have an annual income of 10,000 pesos. The government would utilize the funds to bridge the gap between the rich and the poor instead of widening the gap. That's what a good government will do. It's for the betterment of most citizens. And as I said before, the betterment of one is not necessarily the betterment of the other.
So, good governance is about efficiency in the administration of public funds with demanding high standards of integrity, transparency, and accountability. So, the local fiscal managers or the local treasurers need continuously update their knowledge and skills on their specific area of good governance, which is fund or cash management. So cash management is very important for the local fiscal managers or local treasurers, such that cash is available when it is needed for payment of obligations, and at the same time optimize its utilization, ensures the release allotments are adequately covered by available cash and or future collections, and provided information to facilitate the control of expenditure. So good governance means that process and institutions produce results that meet the needs of society while making the best use of resources at their disposal. So the concept of efficiency in the context of good governance also covers the sustainable use of natural resources and the protection of environment.
We'll discuss the government enterprise operation. Of course, LGUs enjoy full autonomy in the exercise of their proprietary functions and in the management of their economic enterprise, but subjected to the limitations provided in the Local Government Code of 1991 and other applicable laws. Every LGU created or recognized under the Republic Act 7160 is a body of politic and corporate endowed with powers to be exercised by it in conformity with law, which means a local government unit cannot go decide things on its own because it might possibly be in conflict with the law. So the local government should always consult the local government code and any all and any limiting laws in terms of their exercise of authority and their powers or they serve as a political subdivision of the national government. In short, the national government is the head of the government. And the local government units are the employees. They are always subjected to follow what the national government shall mandate, as the national government's authority encompasses the whole state, while a local government unit encompasses a local region or place. That's all, and thank you very much.